question I have, how many of you would like to increase your retirement money or stop overpaying Uncle Sam? I don't want to say stop paying. I want to say stop overpaying Uncle Sam. Let me see a show of hands. Okay, so that should pretty much be everybody. If not, the rest of you want to overpay Uncle Sam, leave him a tip, and you guys don't care if you have retirement money, right? Now, I am all about making sure that our government gets paid the correct amount of money, but I want to follow the rules. I am going to definitely follow the law, and that's real important to me, to operate 100% in integrity. So the things that we talk about are going to be as it pertains to the code and the rules. So this conversation is for you if you are looking to supercharge your retirement account, if you are new to trying to save for retirement, if you want to get into real estate, if you're sitting on money that you just think, you know what, this stock market has been doing great lately, but I'm not so sure where it's going. I want to invest some of my money in real estate. Who knows what's going to happen? But I just think that if you're sitting in that position, that this is a conversation for you. We all started somewhere. I am love the fact that I see younger people that are starting out in real estate. And then there's our midway people, and then there's the older people that have been in it for a long time, right? And they've accumulated a lot of real estate properties. They've been doing it for a while. And the middle people are just now starting to find their groove. And the younger people are pretty much confused about which direction they should go. You guys agree with that?
Yep.
Right? They're just like, I don't know if I should get my own single family home. I don't know if I should invest in this or do that, or what should I really do? So I think that as we go through this conversation, we're going to kind of figure that out a little bit. What should you do? And I believe that at the end of the day, we still going to operate with the same system, right? We still going to get some real estate if we can, because at the end of the day, the dirt is still valuable. Monopoly is still around, and it was around when I was a little girl about 15 years ago, right? So Monopoly is still around, and back then it was all about the property. I think it's still all about the property right now. You guys agree with that? All right. I think Monopoly now it's different. It used to just be basic, but I think they have like branded Monopoly games, right? Or something like that. I don't know. Just Park Place and Broadwalk, that's it. All right, so over the next 15 minutes, we're gonna learn how to supercharge your retirement account. We're gonna learn the difference between seed versus harvest money, and we're gonna learn about this new Roth investing strategy, and what is that, right? I love how people come up with these different terminologies, and it confuses a lot of us, so let's just get an explanation on what that is, so that we can all be on the same page and all be in the same conversation together. So if any of this sounds like you, and I know it probably does, is that there's so much information out there on how to invest, you're paralyzed and can't invest, right? You don't know what to do. There's so much information on the internet, and I just want to put it out there, the internet is not authority, right? Anybody can post an article on the internet, anybody can do a blog, and you can Google and you can probably find it. But what I'm finding often is a lot of people think that everything that's on the internet is actual facts. Some of it is, and some of it's fiction, and some of it, I don't know where it comes from. But I just want you guys to know that the internet is not necessarily the ideal place to find the actual answer to something. Some of you may be thinking about, I want to lower my taxes, but I don't want to get in a tax slinky. I want to supercharge my retirement account, but I really don't know how. I need money for retirement, but I need to invest. Like, what is the answer? And if that's rattling around in your head, then I think you kind of come to the right place to get some answers to those questions. Do you guys kind of feel like that, which direction you should go, right? I have some clients that are sitting on a lot of California real estate, and they're vacillating back and forth whether they should sell all their California real estate and go to another state. Right? I have clients that are saying, well, Carla, I think I should do syndication. Well, I just want to get out of real estate. I'm sick of the tenants. Or I don't know about these California rules and laws and all of these things. And I think there's always going to be regulation, right? I don't think we're going to ever be able to control that. But I don't think the dirt is ever going to go away. So I am going to teach you how to supercharge your retirement accounts, how you can do both, how you can choose to be invested in real estate and still be tax deferred if you want to be tax deferred, right? And we also need to kind of think a little bit about tax deferral as we move into the conversation, because at some point the key word is deferral. At some point we're going to have to pay tax on that money. Hopefully we can kick the can far enough down the road to where maybe I don't pay tax, but my 4 sons are going to pay tax, right? And after that, I don't really care at that point. Sorry, boys, right? Yeah. So that's the theory, but at some point, somebody's going to pay tax. I just want to make sure we understand tax deferral, not tax-free. So our old way of thinking was to think that we couldn't have both. But I want to teach you a new way. How can we take our retirement money, save for retirement, be invested in whatever it is we should be invested in? If we were working with a financial planner and they say invest in stock or mutual funds or whatever that advice is that they give you, how can we do that? Perhaps be invested in real estate and maybe even be invested in a business. How can we do both or all three with maybe some money that we have sitting around and avoid some tax? That's really about the conversation. So let's think about it. Once you move to a new way of thinking, it really opens up a whole horizon for you. You literally will be able to save. You can have your retirement money. You can be invested in the stock market. I kind of feel like people that invest in real estate are opposed to the stock market. Am I wrong in that thinking? Do you guys believe that? Right? You're either a real estate investor. How many of you are real estate investors and are kind of like not stock market people? Okay, how many of you are stock market people? One person, two? Okay, wait a minute, your guys' hands are coming up, so we're gonna do this again. How many of you guys are invested in the market, whether it's mutual funds, whether it's stock, anything like that? Okay. How many of you guys are invested in real estate? How many of you guys are in both? Okay, so some of you guys are in both. Good, 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 good. There are some people that are opposed to being in the market. They just want to be in the real estate. And the people that are in the market don't really like being in real estate. So sometimes I get this real divide among people, right? I think that you have a little bit of everything. That's what my philosophy is. Because if one is up, the other one may be down. I just think if we have a little bit of everything, we'll probably be okay. Who knows? I'll let you know when I'm ready to retire so many years from now, because I'm just way too young to think about that. All right, so I'm Carla Dennis. I've been featured in a lot of different magazines, Forbes. I've written books. I'm in the process of writing another book. What does that really say? The only thing I want you guys to take away from this is that I do eat and sleep this stuff. This is truly what I do. A lot of people come to me to research out their tax situations. I do a lot of work for other accounting firms that really just don't understand how to apply tax law. And that's okay, because it is a specialty that you really do have to learn how to actually apply it. It is completely different from tax compliance. Tax compliance is when we fill out our tax forms from January through April, you bring your forms in, that's tax compliance. Tax planning and law is a completely different area, right? And it doesn't mean that both people know both sides of the equation. Just as an FYI for you. All right, so are you guys ready to get started? Yes. All right. So what are some ways to grow a robust retirement plan? And this is where we get audience participation. Anybody? I know your names. So what's a way that we can grow a retirement plan? Some of you are in here are retired. I know some of you are retired. How do we grow our retirement?
Save your money.
Woo, who said that? Save your money. I like that. And when you save your money over time. There's no hit the lottery, right? And all of a sudden you retire. Save your money. What other ways are there?
Invest.
Who said that? Invest your money, right? Save your money, invest your money. What else?
Minimize your tax bill.
Minimize your tax bill. Okay? There's about 3 things that you could really do. 3 major ways to get yourself some retirement money. And you guys kind of hit it on the head with the hammer, really. You got to save your money a little bit over time. Just gradually start to save. Even if, I tell my kids, my youngest son now is 17, and I am never going to let him grow beyond 17, poor kid. I tell him all the time, save your money. Save some of your money. You can't use every dime that you make or your allowance. You got to save your money. So it definitely starts with that. I am a big proponent of budgets. It doesn't matter whether you make $10,000 a year, $100,000 or $1 million. I budget for everything. So I have a line item for savings, for college, for hair, for whatever it is. I budget for every single thing. Because to me, if you don't budget for your money, you were probably on Black Friday, what's that, Amazon Day? Prime Day, right? Prime Day shopping randomly, just because it was Prime Day. So I'm admit, I logged into that website. I said, Carla, get off this website right this moment, right? How many of you guys shopped on Prime Day? I'm curious. How many of you going to admit you shopped on Prime Day? At least you're honest. She raised her hand. She said she shopped on Prime Day.
I knew exactly what I wanted, and I bought the one thing I wanted.
And then you got out of that shopping cart quickly.
And it's a business write-off.
All right, I'm not. That's excellent. Okay, so that's what ends up happening when we don't budget, right? We just kind of randomly out there. I kid you not, when we started to get debit cards, I think that we failed to realize just how much money we spend. When we used to have to take our physical cash out of our pocket and spend it, it was harder to let go of a $20 bill, and you knew you weren't breaking 100. If you had a $100 bill, you were not breaking it, like forget it, right? But now with these debit cards, it doesn't matter. We'll do a debit card for $2. It has gotten out of control. So now I've gone back to using cash. Because when I let go of my cash, I feel that a little harder, right? And I give my kids cash, or I don't give my older kids anything. Matter of fact, I take from them. But my younger one, he still gets money. All right. The other thing is invest your money, or you can borrow money and invest it at a higher interest rate. That used to be a way people used to do it. They borrow money. It's called OPM, using other people's money, right? Who still uses other people's money today? The banks. The banks take our money. If we were all to go run down to the bank, they probably wouldn't have your money, right? If we all just decided to go pull our money out of the bank, we'd be in trouble. I will never forget one time I went to my business bank and I wanted to pull out some cash. And they told me they had to order it. I'm like, wait, what? I said, oh, you guys are making me real nervous right now, right? You got to order my cash. Don't you have a vault back there with cash in it? Because you guys are confusing me. It wasn't that much money. Honestly, I think it maybe was like $15,000 in cash. They had to order that money. I'm like, oh no, you guys are only getting $15,000. So now I got bank accounts at every single bank, right? That makes me just super nervous. All right, so banks do that every single day. They take our money and they invest our money and they use it some other kind of way, right? And then they pay us 0.5% on our savings account. So that is just what we call arbitrage. People do it all the time. I think that you got to be sophisticated to be in that realm, but there are people that do that for sure. All right. So what are some considerations? I think a little bit goes a long way over time. Dollar value averaging. You just got to save over time. There's not any fairy dust. There's not any magic to it. You literally just have to be disciplined to that particular cause. Again, create a budget and just sit back and let it happen, right? It's not going to happen overnight. Even though I think this social media and Instagram has made it seem like everybody has turned rich overnight, it does not happen that way. It's a process that I think we all are aware of. All right, so if you invest your money, you can certainly invest your money in some of the traditional investments, retirement savings accounts. I still think that's a wise decision to put your money in IRAs or Roth IRAs or whatever the case may be. I think you should have a little bit of that as well. I think that you should be invested in real estate if you can. I think that if you can invest in some type of business, and you can have all three if you can. So let's talk about the traditional investment versus like the Roth investment, right? The difference between the seed and the harvest. So When the IRAs came out, it was really a way for people to start saving their money with the theory that when you became older, you would need less money to live off of. I can tell you, I have clients that are retired now that they have more money in retirement than they did when they were working, right? So that theory of you're going to be in a lower tax bracket when you retire, I don't know that many of us want to be in a lower tax bracket when we retire. Let me take that back. I want to be in a lower tax bracket, but I don't want to have lower income. How about that, right? I want to have more income. Because there's a cruise that Norwegian does, it's 365 days, and I plan to go on that cruise, right? So I'm going to need money to do that. Bottom line is, we're not going to be in a lower tax bracket in terms of our income level. I don't think most of us will be. But I think ultimately we need to get our taxes low. The traditional IRA, traditional 401k allows you to defer tax, where the Roth allows you to save money and you don't pay tax on the growth, right? That's the seed versus the harvest. So the decision has to be made, do I want to save money now, right? Be tax deferred on the seed, or do I want to be tax deferred on the harvest later on down the road? And I think that we got to look at both sides of the equation. I don't think there's a one answer fits all. I think it's something to be looked at. So when people say to me, should it be an IRA, should it be a Roth? I said it always depends, right? On how much you have to save or what the case may be. It's just different ways to look at it. But there's not one answer. So just realize that, something for you to analyze. Where will you pull your money from when you retire? And something to consider later on down the road. All right. So how do you get all three types of these investments and avoid tax? Does anybody have any idea?
Create a business.
Create a business.
Corporation.
Who said that? What's your name?
Ryan.
Ryan said create a corporation. You said create a business. Anybody else?
Invest in real estate.
You don't get to answer, son. Anybody else? Okay, create a business. But we want to get to all three of those investments. Would you guys like to get to all three?
Yes.
Retirement, deferred, some real estate, a business, right? Okay, let's talk about how we can make that happen. There's really two strategies that I want to talk to you guys about. And I want to talk about these two strategies: self-directing IRA, self-directed retirement funds, and I want to talk to you about the ROBS, the rollover business startup strategy. I want to talk to you about that. Now, the reason why I want to talk to you about self-directed IRA is because a lot of people are doing this more and more and more. They're taking their 401k money, their retirement money, and they're going out and they are self-directing and they are purchasing real estate. Sounds very common. I'm sure you guys have heard of that. Is that correct? A lot of you have heard of that. Except for what I am seeing now is there are a lot of audits happening because people who are self-directing with these IRAs are not doing it properly through a custodian, or they are doing prohibited transactions. They're doing prohibited transactions. So let's talk a little bit about what that needs to look like if you are going to do a self-directed IRA. And I really want to go over this because I have two cases right now that have come to me recently of clients that are in situations because of this very thing that I want you guys to make sure that you guys avoid if you decide to do this. So number one, if you are going to do a self-directed IRA, you need to get a custodian. You need to get a custodian to help you do a self-directed IRA. You are not the custodian. That is a company. This is what they do. They manage IRAs. That's very important for you to do that. When the custodian sets that up for you, they will then allow you to have checkbook control over that IRA. where now you can use that money to invest. But here are some things that you cannot do. You cannot take your personal funds and put it inside of that checking account. You cannot do that. That is really important. If you are invested in real estate through that IRA, you cannot take your personal money and pay the property taxes. You cannot take your personal money and pay the insurance. You have to make a contribution to your IRA, and then the IRA pays for those things. I have a situation right now with a client that inherited a self-directed IRA from her mom who passed away, and the IRA did not have enough money to pay the property taxes on this particular property. It's like 10 grand. She paid for it out of her pocket, thinking that was the right thing to do. She did that for 3 or 4 years. Now the IRS has come back and has said that entire IRA is now subject to tax. And there's a lot of money sitting there, okay? So we don't want those types of things to happen. You do not want to have what we call prohibited transactions. Okay, you guys with me? So prohibited transactions where you're self-dealing, where you are going back and forth with your IRA money, where you're taking that money and you are using your personal funds directly to pay for something that the IRA should pay for, or you're putting that money directly into the checking account of the IRA versus contributing to the IRA and letting the money come from the other direction. Are you guys following me? It's really important to know how this works. Is this a good tool if you're sitting on some money where you want to self-direct and invest in real estate? Absolutely, it's a great tool to utilize. But doing it right is really important. So what are the tax implications if you invest in real estate through your IRA? You do not get to flow that rental income or loss. You do not get the benefit of that rental income or loss. Okay? You don't get the benefit of that. So let's use this analogy. I have a piece of real estate I bought outright, had my mortgage, whatever the case is, in my own name. It appears on my personal income tax return. If I have a loss or whatever the case may be, it shows up on my personal income tax return. I get the benefit of that. If it's in the IRA, I don't get the benefit of that. So you lose out on some of the benefits, the tax benefits. But at the end of the day, would that be a choice to be inside real estate versus to not? Absolutely. Absolutely. If that's the only way that you can do it, and you're sitting on deferred money, would I do a self-directed IRA? Yes, I would do a self-directed IRA. Because at the end of the day, you're still in the real estate market, right? And as the market goes up, your property goes up, the value of your IRA goes up. So all of that happens within the IRA itself. You guys follow that piece? Okay, it's really important that you understand that. So you can self-direct, you can have checkbook control, you cannot take any money out yourself, because if you take any money out of that IRA yourself, you're definitely going to get hit with income taxes, and it can cause the whole IRA to possibly be what I want to say taxable. So we want to be careful of that. So let me walk you through the steps of what that needs to look like. So number one is you are going to establish a self-directed IRA with the proper custodian. That's the very first thing that you're going to do, with the proper custodian. Somebody that does that. If they do that, it's probably on their website that they do that. They probably have a history of doing that. Not somebody that says, oh, I can go ahead and do that for you. Not that person. Somebody that actually does it on a regular basis. Then your retirement funds are going to be transferred to the custodian. Transferred to the custodian. Notice I did not say that there was going to be a direct rollover. There's not going to be a rollover. It's going to be a direct transfer to the custodian, not a rollover. A rollover is a little bit different. A rollover is where I can get my money, I can hold it for 60 days, then I can put it back deferred. That's something different where I could get it. We want to go direct. Okay? The custodian goes direct for you. A limited liability company is then set up, an LLC is set up at the direction of the IRA owner. You can now transfer those funds into that checking account, and you as the manager can now decide how to invest that money. Are you guys with me on that? Okay, so that checkbook is not for you to go out and buy your groceries, and you cannot have a credit card. You cannot have a credit card with a self-directed IRA. You can have a debit card, but not a credit card with a self-directed IRA. Just an FYI. A great strategy if you're sitting on money, you want to get invested in real estate, you don't want to get hit with the taxes, and you want to just continue to kick the tax-deferred can down the road. Are you guys with me? Okay, very good. Now, do you guys see any problems with this type of strategy at all? No?
Well, I'm not sure how you get your money out.
That's the problem. You're a smart lady. This lady is shopping on Prime Day and she's asking the right question. How do you get your money out? If you get your money out, just like you would take your money out of an IRA, it's going to be a distribution, just like an IRA. So if you're not 59 and a half, then you're going to get penalized unless you do a 72T distribution, and that's another strategy. But you could potentially get penalized, right? So this is a strategy for you to get in real estate, but we got to be careful when and how we pull the money out. Can't just take it out and use it. It's in your IRA to grow and supercharge your retirement fund.
So like your girl that got hit with the taxes, the whole IRA. So was the value of the real estate also included in that hit?
Yep. The value of the real estate was included in the hit because the value of the real estate is about the investment in the IRA. That's exactly correct.
So that was like income tax.
Right. That's income tax. And she's not 59 and a half. So we're going to plead complete ignorance on that case and see what we can get, right?
Right.
We're going to figure it out for her. That's for sure. So that's why if you do this strategy, it's still a retirement account. You're just invested in real estate through your retirement account, right? Is it a good idea to be invested in real estate in a retirement account? I would say yeah, if you want to get in the real estate market, it's a way to get in. It is definitely a way to get in. And there's ways to get your money out, not tax-free if you're below 59 and a half, but without penalty if you're below 59 and a half. There's ways to slowly get your money out, okay? There's a strategy we can use for that. But we need to kind of weigh that out and decide when we're going to pay some of the tax, okay? All right, so that's one way you could do it. The other way is what we call the Roths. Have you guys heard of this strategy, anybody? No? Okay, so the Roth strategy is a rollover as a business startup. Rollover as a business startup. This strategy is fairly new. The name is new. And the way this strategy works, it's similar to the self-directed IRA, but I want you to think of, name a fancy car that you would like to drive.
Lamborghini.
It's always the man that says a Lamborghini, right? What would some of you women like to drive?
A Dodge Challenger Hellcat.
A Dodge Challenger Hellcat, okay? Anybody else?
Bugatti.
A Bugatti?
Tesla.
Tesla? 7 Series BMW doing 110 on the way to Vegas? Yeah. All right. So the Roth strategy, I want you to think of the Roth strategy to be like that Lamborghini and that Tesla and that BMW and that Dodge Challenger. This is the Roth strategy, okay? It's that fancy car that you want to drive. Let me tell you how this works. Step one, this is where you literally set up a C corporation. A C corp. C corporation, not an S corp, not an LLC, a C corp. That's very important. The business that you just set up will now adopt a 401k plan. The plan participant will have your retirement funds rolled over to it. So now you're still rolling over your retirement account into this new plan inside of this new C corporation. And you're going to use your retirement account to purchase stock in the C corporation. You're going to get checkbook control. Now here's the major difference. With this C corporation and using this strategy, you can actually take money out of this corporation because you can put yourself on payroll and get paid. You can take money out of this corporation. You can take that money and you can decide how to invest it inside of this corporation. And you can take money out through a payroll. The rules as it pertains to not being able to utilize any of the funds are a lot more lenient on this strategy right here. You decide what operating costs your C corporation has. You decide what operating costs the C corporation has. On the self-directed IRA, the government has already laid that out. It's not that way under this strategy right here.
So when you have checkbook control, if I wanted to pay for my Medicare sub, I can do it through my C Corp?
If you put yourself on payroll and make that a benefit,
Okay.
absolutely. You can do it through your C Corp. This allows you to start a business, right? Any type of business that you want. There is not any type of, as of today, when I looked at about 4:30, and I must caveat that, there is not any rule on a certain type of business that you cannot start. So if you wanted to self-direct your money and go open up a franchise, or if you wanted to do any type of business whatsoever, this is a way that you could get it going, okay? You could also put your own funds into this business. So this is not going to be a prohibited transaction. You follow me? Whereas on the other self-directed IRA, you cannot do that. So this allows for a lot more flexibility for people to be able to start businesses and really take it to another level, because a lot of people like to start businesses, maybe start a real estate business, whatever the case may be, but they need that seed money, right? And they don't want to pay taxes on it. But you can do this. Are you guys with me? Okay, so let's talk a little bit about some of the pros and cons. On both of them, on the Roth strategy, both of them, you're investing in yourself. The LLC, self-directed, is a little bit more simpler because it's just an LLC. A corporation, obviously you gotta do your minutes, you gotta do all of those other little things. It's a little bit more complicated, but you have a lot more flexibility with it. You have different ways that you can go about doing it. The self-directed IRA is more familiar to people. There's a lot more custodians out there. I would say right now, and I hate to use this term, but I'm gonna use it. The Roth strategy right now is sort of like the Wild Wild West. The IRS has not come in and clearly defined how this is going to go, right? So those people that are in that first, they're going to get grandfathered in, right? Once that rule hits, you're locked. And who knows what the rule is going to look like. But right now, there aren't any. Just as an FYI.
So
Okay.
with that being said, let's say the rules change, are they gonna make it difficult for us to get our money out?
No, because if you created this under a certain rule, you're grandfathered under that rule.
Okay.
It will not apply to you.
Okay.
Just like, for example, I told clients that were thinking about divorcing last year to get divorced, because those who paid alimony can no longer deduct it, and those who were receiving alimony had to report it, right? Now it's over. If you divorced in 2019 and you pay alimony, it's not a deduction, and to the recipient, it's not income. People who divorced before that, I know, why are you looking like that? You think about getting divorced?
No.
She was like, wow, I didn't know that. Just
Wow.
well, yeah. So that's tax planning hits every aspect of your life. It hits every aspect of your life. So those are just things. The old people can still deduct it. The new people can't deduct it. That's just the way that it's going to go. And there's a lot of rules that are like that in the tax code. Just as an FYI, I am certainly not a proponent of divorce. Let's not go out there spreading that rumor. I'm just using it as an example.
No, I'll kill him off first.
Me too, because of that life insurance, right? All right. So the Roth strategy obviously is a little bit more costly to set up. It needs someone to help you with your books and records. I mean, the bottom line is, it is to me a really excellent way that if you're sitting on some retirement money and you really want to go next on something that you were thinking about doing, that's the way to get it done. But it needs to be done properly. Self-directing through an LLC to purchase real estate, can you do that too? Absolutely. I think that for one strategy, you got to be really, really disciplined, and you need somebody to guide you. The other strategy, you got to be disciplined on both, but the rules are not as stringent, right? So there's opportunity for you to move money, invest, have money in the stock market. You don't have to move all your money. I will never tell anybody to invest 100% of your funds in any type of business, right? Because businesses are easy to start, hard to keep going, and really hard to get out of. So I would just tell you that you always need to talk to somebody as you are thinking about any type of investment, how much to put in, what's your strategy, what's your exit plan, do you have that extra cash to lock up? You always want to be prudent when you're making decisions. I think that the way to make a decision is to go fast, slow, to really take the time to vet it out, because too many of us are just out there just doing stuff and we don't really think about it. Do that if this, then what scenario, so that we can really figure out what really needs to happen. So just something to consider. It's all about the conversation. So at the end of the day, which one of these strategies is right for you? Which one? Do we know? Right?
Corp,
The C Corp is right for you?
I would say.
You would say?
You gotta do the numbers.
You gotta do the numbers, right? I would say you gotta do the numbers too. I would say that you gotta look at the whole planning component of it. I would say that before we were to say definitively a C Corp is right for you, and it might be, we gotta run the numbers. We gotta look at it. We gotta vet it out. We are here today. Where are we gonna be 6 months from now? December 31st, 2020, right? December 31st, 2021, where are we gonna be then? What's the strategy? We absolutely have to do planning. And I cannot anchor this conversation enough about doing the tax planning. Everything you pretty much do is gonna come back to your tax return one way or another. And if you can get your tax people in that conversation before you do those things, I am certain your tax bill will be less, whether your tax bill is going to be less or whether something you do off the tax return is going to cost you less, right? It's all about having those conversations. And I think that's really important. So let me tell you the way that looks. It is definitely all about the 7 prongs of planning, the 7 prongs. And I'm going to always tell you guys this every time I see you. So you're going to be like, oh my God, here comes Carla. She's going to talk about planning. I'm going to always talk about planning because I think it's so critical. And I think that whether you planned last year, we're in 2019 now. And unless you don't plan on making any more money, then you need to plan again and again and again. And it's never going to stop if you want to grow your wealth. So you have to get yourselves organized. That is the most important key. If you do not have yourselves organized, let's have a conversation about how to get organized. I love it when clients can bring me their whole financial world on a spreadsheet. And it doesn't mean everybody can do that. Some people can do that and some people can't. But I just think that if you could really put your world on a spreadsheet and just really see how much money you spend. The first time I did that, I gagged at how much money we spent out eating, right? I was like, oh my God. Like my husband would say, we go out to eat all the time. I'm like, no, we don't. But then when I did those numbers, I had to like erase the numbers so we couldn't put our numbers on a spreadsheet. So I think it's important that we do that. So first thing is we absolutely gotta get organized. The second thing is we gotta review our past history. It's important to review the past. Extremely important. I am going to look at past years' tax returns, years, plural, tax return, to see what's going on. And we're gonna have a conversation about it. Even if I did your 2018 tax return, we're gonna have a conversation about it. Because I know for certain that a lot of us don't understand tax returns, and I don't expect you to. But every time we talk about it, you're going to get a little bit smarter and a little bit smarter. And as you get smarter, you can make smarter decisions, right? You learn a little bit more knowledge every single time. It's almost like sometimes you go someplace, you go, I never noticed that. And that had been there the whole entire time, right? We're just looking from a different perspective. So we always want to review the past. Once we do that, review the past, we need to assess the current situation. Where are we today? What do our 2019 tax liabilities look like? We are 6 months into the year, and Christmas is coming. Not Thanksgiving, I said Christmas, right? I'm trying to skip over Thanksgiving because Thanksgiving is a very fattening holiday. So Christmas is coming, and we need to know where our tax liability is. We need to figure it out. And some of you may say to me, well, Carla, I own a business, so I don't know yet. Yeah, we know. We got some degree of where we're going. And we're going to keep sharpening those numbers as we go. But we got to get a handle on where we are and keep moving a little bit so that we know where we need to go. And most importantly, we have to understand our vision. What are we trying to do? What are we trying to accomplish? Because we may need to be a C Corp, and you may need to drive a Lamborghini or a Lexus or a Tesla, our 7 Series BMW that's all white with red interior and beautiful rims, right? You might need to drive that, I don't know. But we gotta understand what we're trying to accomplish. And I think that's important, to really think it through. And we may not know 100% and things change, but I think it's important to sit down, be strategic, be thoughtful, vet it out with somebody that you trust, your trusted advisor. And the one thing that I can definitely say is we see a lot of things with clients. We really do. We see a lot. And to sit in our seats as advisors, as accountants, we have the windows to what everybody is doing, good, bad, or indifferent. That's just something that we can pass along. Do not do that. Do not use that property manager over there in Texas on that street. Because believe me, we keep track of that type of stuff. So it's just important for you to understand your vision. Then once we understand that, then and only then can we implement the right strategies. We got to understand it. What's at your heart? What's the most important thing to you? What's important to you might not even register on my radar. We had one client we were recently dealing with. He owns his own business, and we're doing planning with him. And he said, Carla, the most important thing to me is keeping my medical coverage. Because right now, where I am with my income level, I can keep my medical coverage. And if I let my medical coverage go, I have a special needs kids, and it's going to go through the roof. That was one of the most important things for him. So understanding what's important to you is key. Not what I think is important to you, but what's important to you, right? And nothing that is important to you is trivial to us. Everybody has different things. I have one client that sits on a lot of money, and she said what's important to her is that she not leave a dime to her son. Where I'm the opposite. I'm gonna leave my sons at least a quarter, right? She's not gonna leave a dime to her son. But that's her vision. My vision is to pass down my business to my sons, and when I'm dead and gone, their kids will own it. My granddaughters will own it. Not my grandsons, but I know I'm going to get granddaughters, right? How many of you guys want me to have granddaughters?
I do.
Thank you. Exactly. That my granddaughters will be running that business someday. That's my vision, right? The key is We want to know what's your vision so we can implement the right strategies for you. Not the strategies for your neighbors, not the strategies you read on the internet, not the strategies you think you need to have, but literally the right strategies for you. And I think that that's the difference that we really make as advisors, to really try to figure out what's important to you. Because that's really all that matters. I mean, at the end of the day, when the bell is rung, all we have left is our own legacy and what was important to us. So that's key. Then, once we get that sorted, we have to continue the conversation. The conversation does not end when you get your tax returns. It's just beginning. Tax season is compliance season, and we're doing tax returns during tax season. That is not the time that we are doing planning when we're at the tax meeting. We might open up the planning conversation, but tax planning is its own separate thing. That's almost like you go to the doctor for an ear ache, and then you tell the doctor about your knee, and you want them to do knee surgery while you're there trying to get something for your ear, right? That's not the time for that. Planning is a completely separate component. And people think that when their tax preparer does their tax preparation, that they're supposed to be doing planning. That's not planning, that's tax preparation. I get that a lot when new clients come to me. They'll say, Carla, I don't like my old tax person because he didn't do any planning for me. And then my question I will ask, well, did you hire that person to do planning or tax pro? Right? There's a difference. I think that we as professionals, we need to own that conversation and tell you guys that it's not one thing. It is two separate things that you need to really look at. So I want you to think of it as when you go to your doctor and you just go for your regular annual checkup, that is just like going and getting your tax preparation. That's your regular annual checkup, whatever the case may be. When you are doing planning, you are really going through step by step every process of the tax plan and really trying to figure it out. And you really want to work with a brain trust. And I say a brain trust because I don't have the biggest brain in my office by any stretch of the imagination. I have very intelligent other people in there. And collaboratively, we have a big brain trust. I am never going to say that I know it all, and I don't think that anybody on my team will say that they know it all. But when you're working with people that have had 30 plus years of experience on top of 30 more, on top of 30 more, I'm guaranteeing you we're going to come in pretty smart on with that knowledge, right? We'll figure it out. I probably have the least amount of knowledge because I'm the youngest in the group, but I'm sure we'll figure it out for you guys. So brain trust is important, strategy is important, having those continuous conversations is important, and planning all year is important. And I'm never ever going to stop stressing that. The runway starts right now. It's literally like if you had to take off at LAX, and when that plane takes off on that runway, you don't expect that plane to take off on that runway and just literally get up in the air, right? It just takes off and it goes. The more runway you have to plan, the better plan that you will get. So the one thing that I will say to you guys, that if you're interested in planning, we always will offer a complimentary consultation. You probably have these cards on your desk. Fill them out. We will certainly talk to you or not, whichever you prefer. But I am always about the education. If you haven't done planning for 2019, the time is now. Certainly before we get to Labor Day. Definitely before the turkey's in the oven. And certainly before the Christmas decorations come down. We have people that call our office on December 30th saying, Carla, can we plan? I said, we certainly can. I will see you next year, right? All right, so I am going to say to you guys, if you guys would love to have that, please fill us out. The team is in the back. Carlton is right there. And I think for the most part, you guys know my team of people. Carlton is right there. We have Khalil in the back.
Can I say something really quick?
Yes, you may, son.
I met with a lot of you guys already, which I love. If you guys are planning on filling out a consultation card, be ready to come with your guys' most recent tax return. It's like looking at your DNA. I will literally locate what areas of opportunity you guys have missed out on, and we'll figure out how soon we can get started on tax planning. Okay? Awesome. Thank you.
All right. Well, I am going to wrap it up with this. I am Carla Dennis. It is always my pleasure to talk to anybody that wants to talk tax. You guys have a nice evening, and I will hang out if you'd like to talk to me.
Accepts IRA, check to